Welcome back to Daily Dispatch. Today we explore the financial sector's climate challenge. Don't forget to like, share and subscribe to our digital AI news channel for latest updates. An estimate of the damage caused by climate change was recently looked at by an economist team after 20 years of peer-reviewed research on the social cost of carbon. They came to the conclusion that the average cost is significantly higher than even the most recent figure provided by the U.S. government when improved methods are taken into account. As a result, greenhouse gas emissions will have a larger impact over time than regulators anticipate. As apparatuses for estimating the connections between atmospheric conditions and monetary result develop, and the communications among climate and the economy amplify the costs in capricious ways, the harm gauges have just risen. The financial sector, which closely monitors economic developments that may have an impact on portfolios of stocks and loans, should be concerned by this kind of data. But even a ripple was hard to see. As a matter of fact, the report from Money Road of late has generally been about retreat from environment objectives instead of recommitment. Banks and asset managers are unhappy with the rules of international climate alliances and are leaving. Local banks are moving forward loaning to petroleum derivative makers. Many sustainable investment funds have failed as a result of crippling outflows. What then accounts for this apparent disconnect? At times, it's an exemplary detainee's predicament. Everyone will benefit more in the future from a cooler climate if businesses collectively switch to cleaner energy. However, the transition is much more difficult to achieve because each business has its own unique incentive to profit from fossil fuels in the short term. The financial sector is truly unable to comprehend what a warming future will mean when it comes to avoiding climate damage to their own operations. Put yourself in the shoes of a banker or asset manager to comprehend the situation. When President Biden reinstated the United States' participation in the Paris Agreement in 2021, his financial regulators began issuing reports regarding the threat that climate change posed to the financial system. In the hope that governments would establish the regulatory and financial infrastructure necessary to make those investments profitable, a global agreement of financial institutions pledged $130 trillion to reduce emissions. The Inflation Reduction Act was also enacted in 2022. From that point forward, many billions of dollars have streamed into environmentally friendly power projects in the U.S. However, this does not imply that they are a certain bet for those paid to develop investment strategies. High interest rates and supply chain issues have hammered clean energy stocks, forcing offshore wind projects to be scrapped. Assuming that you got probably the biggest sunlight-based energy trade exchanged reserves mid-2023, you would have lost around 20% of your cash, while the remainder of the financial exchange took off. On the off chance that we contemplate what will be the most ideal way to shift your portfolios toward the path to benefit, it's truly hard to do, said Derek Shug, the head of portfolio the executives for Kestra Venture the board. Over the course of 20 years, these are probably excellent investments. However, over the course of 1 to 3 years, it is a little bit more challenging for us. A few firms take special care of institutional clients, similar to public representative annuity reserves, that need fighting environmental change to be essential for their venture methodology and will take a transient hit. Yet, they aren't a greater part. Additionally, for fear of losing business from states that disapprove of such concerns, many asset managers and banks have shied away from anything with a climate label over the past few years. In addition, the financial case for supporting a rapid energy transition was hampered by the Ukrainian conflict. Computerized reasoning and the development toward more prominent ZAP are adding interest for power, and renewables haven't kept up. So banks continue to loan to oil and gas makers, which have been producing record benefits. In his annual letter to shareholders, J.P. Morgan Chase CEO Jamie Dimon stated that it would be naive to simply halt oil and gas projects. That is about the general allure of speculations that would slow environmental change. What about the threat that stronger hurricanes, heat waves that knock out power grids, and wildfires that destroy towns pose as a result of climate change to the financial industry's own investments? There is evidence that investors and banks price in some physical risk, but a lot of it remains unnoticed. The Federal Reserve has asked the country's 6 largest banks to look into what would happen to their balance sheets if a big hurricane hit the Northeast over the past year. According to a summary published last month, the institutions were unable to evaluate the impact on loan default rates due to a lack of information regarding the property's characteristics, counterparties, and especially insurance coverage. Parinita Sastry, an associate teacher of money at Columbia Business College, concentrated on temperamental backup plans in states like Florida and observed that inclusion was many times a lot more vulnerable than it showed up, making contract defaults after typhoons likelier. I'm incredibly stressed over this, since protection markets are this murky failure point, Dr. Sastry said. There are resemblances to some of the intricate connections that occurred in 2008, when a weak and unregulated market spread to the banking system. Regulators are concerned that failing to comprehend these ripple effects could cause not only a single bank to experience difficulties but could even spread and undermine the financial system. Some financial reformers have criticized their systems for monitoring potential issues as inadequate. However, while the European National Bank has made environment risk a thought in its strategy and oversight, the central bank has opposed playing a more dynamic job, regardless of signs that superweather conditions is taking care of expansion and that exorbitant loan costs are easing back the change to clean energy. Johanna Strobel, a finance professor at the Stern School of Business at New York University, stated, "The argument has been, unless we can convincingly show it is part of our mandate, Congress should deal with it, it is none of our business." In the end, that viewpoint might be correct. Risk management is what banks do, and as climate forecasting and modeling tools get better, they can stop lending to places and businesses that are clearly at risk. However, when credit and business investment stop coming in, that only makes matters worse for the people living in those areas. You can finish up it's anything but a danger to monetary solidness, and there can in any case be enormous financial misfortunes, Dr. Strobel noted. It is still difficult to determine where one's portfolio's risks are, but a much more immediate uncertainty is looming, the outcome of the election in the United States, which could determine whether climate concerns are addressed further or whether existing efforts are rebuffed. A forceful environment technique probably won't passage 2 during a second Trump organization, so it might appear to be insightful to sit back and watch how it works out. Nicholas Cadola, a senior portfolio manager at Brinker Capital Investments, stated, "Given the way our system has moved so far, it's so slow-moving that there is still time to get on the other side of the proverbial fence." He made these remarks before joining the Pollination Group, an advisory and investment management firm that focuses on climate change. John Morton worked as a climate counselor for Treasury Secretary Janet L. Yellen. He has seen that large organizations are faltering on environment-touchy ventures as November draws near, however says that 2 things are off track and very risky about that speculation. 1. Financial disclosures related to carbon are already subject to more stringent regulations in states like California, and if Republicans win, they may impose even more of them. 2 more, Europe is progressively working in a carbon line change component, which will rebuff dirtying organizations that believe should carry on with work there. Mr. Morton advised, "Our view is, be careful. You will be burdened on the lookout in the event that you're left holding a major pack of carbon a long time from now." In any case, right now, even European monetary establishments feel strained from the U.S., which, while giving probably the most liberal endowments such a long ways for sustainable power venture, has not forced a cost on carbon. If everyone else did the same, the global insurance company Allianz has devised a strategy to align its investments in such a way that it would prevent global warming from exceeding 1.5 degrees Celsius by the end of the century. But it's hard to focus a portfolio on climate-friendly assets while other funds take on polluting businesses and make quick money for impatient customers. According to Allianz economist Marcus Zimmer, this is the main challenge for an asset manager, to really bring the customer along. Resource directors don't have adequate apparatuses all alone to move cash out of contaminating ventures and into clean ones to remain in business, he said. Dr. Zimmer continued, "Of course it helps if the financial industry is somehow ambitious, but you can't really replace the lack of action by policymakers. Eventually, it's extremely difficult to get around." Hope you like this report. Thank you for watching.